The stock market just hit an all-new high. The Nasdaq, the S&P 500, and the Dow Jones are rising close or at their all-time highs. On Monday, all the major indices gained another 0.5% or more. The Nasdaq gained a full percent. Even with Salesforce being a dud recently, my portfolio has reached close to its all-time highs, now at a gain of $213,000. Apple's at an all-time high of $216. Microsoft has reached an all-time high. Microsoft is now $448 per share. Texas Roadhouse is next to its all-time highs. It's at $171 per share, currently up 43% year to date. Chipotle's at an all-time high, currently $3,365 per share and up 50% year to date. Costco hit an all-time high today. It's currently $868 per share, up 34% year to date. Not only is the passive income portfolio near its all-time highs, but the Story Fund, my smaller but more aggressive growth portfolio, is currently at all-time highs with a gain of $70,300. Google's currently 1% away from its all-time highs at $178 per share. Netflix reached a 52-week high today. It's now at $675 per share, up 44% year to date. And these are just some of the stocks in my portfolio. There's other notable mentions that are racing up or close to their all-time highs. Tesla's making a nice comeback. It's close to $200 per share, but other companies have really blown away the rest of the market. Nvidia being the main one here. It's up 171% year to date. With the market being at all-time highs and racing up every single day, day after day, it raises a lot of questions. What do we do in these situations? A lot of investors believe that we should hold off, we should hold cash, we should wait for a dip. But there's more science to it. There's more data that will clearly illustrate what the best decisions are to do. And I'll be going over what the data says, how we should invest during bull markets and during all-time highs. Now, of course, we have some other news stories we'll get to in this episode as well, including that our Surgeon General is now pushing for a Surgeon General's warning on social media, very similar to the Surgeon General warning on cigarettes. And we have news that the US is officially suing Adobe over deceiving subscription practices, claiming that Adobe products, which are very expensive, are simply too hard to cancel. So we have a lot to get to in this episode. I appreciate you for joining. Let's go ahead and dive in. First, starting off with what do we do in a bull market? This is something that there's a lot of opinions about. Everybody wants to know, should we buy or should we wait? Should we wait for a dip? What decisions should we make in this type of environment? Now, the first thing that everyone seems to do in a bull market during all-time highs is try to predict when it will end. Try to predict when things will finally fall apart and we'll go back into a bear market. This is like the debate phase of the bull market, and you hear these type of debates during every single bull market. In fact, we just heard this debate today.
But in an election year, and I came on with Scott a while ago talking about this, you tend to see your summer rally, right? June, July, August, usually really strong. So we're still in that strong seasonal time frame, Mike. And then I like to look at credit spreads, right? Investor grade corporates, what's going on there? There's no monster under the bed, right? We're not seeing any major stress in credit markets. We're hitting literally the 30th all-time high of the year for the S&P as we sit here and talk today. So there's always worries, concerns, but bigger picture. We're overweight equities. We have been since December of 22. Mike, we still think there's pretty good upside the second half of this year coming.
He's stressing that right now we see a bull market that's consistent with many election year summer bull markets. It may cool down a bit, but this is the type of commentary I see every time during a bull market. You have people brought on, many guests, debating the intricacies of what's pushing the market higher. In many cases, these are short-term focused outlooks. They're looking over the next year and trying to debate whether or not the market will continue higher or go lower. So we have bullish takes like this, that the market's going higher and it's going to have a little bit of a break, but it will continue higher. And then you get the other side where they bring on guests that give their reasoning of why the market is going to go lower. Here's an interview from a few months ago during a raging bull market, why a market correction is long overdue and this market's going down.
We did not see, as many strategists didn't see last year coming, right? The recession that wasn't. And that held us into a more conservative position and didn't reap the benefits of especially that fourth quarter run up in stocks. But, we're not out of the woods yet the way we see it. And you certainly don't need me to read off that laundry list of economic and geopolitical, issues that we're still facing. But I guess we'd argue that whether or not there's a soft landing or a hard landing / recession, which is the current debate, that we see that as academic. stocks have already priced in a pretty rosy scenario here for the most part. And so we don't necessarily see where the fuel is going to come from for much higher stock prices, relative certainly to fixed income securities.
He's bearish on stocks. He believes that they've already priced in a bright future and there's not much reasonable upside. The S&P 500 reported earnings, and those earnings were much stronger than expected, causing the stock market to sail upwards. And on goes the endless debate of what direction the market's going. Luckily for us, we have much better data to look at. One of those pieces of data that mirrors a lot of other studies on the subject is a study called Investing at All-Time Highs by RBC Bank. They highlight early on in this study that the problem with the market racing to all-time highs is a lot of people stop investing. They hold off investing because they have something called a psychological barrier to entry. Another phrase for this, or another psychological thing to explain this, is called anchoring bias. Anchoring bias is a well-studied phenomenon where you started investing at a certain point. Like, let's say I start investing back here and the market raced up, my portfolio made gains, so I no longer feel like I'm getting good value in my portfolio. Because remember when I was buying it all the way down here? That was such a better price. Now things are more expensive, so I no longer want to invest. Anchoring bias is where you no longer make decisions based off of the current data because you're mentally and psychologically anchored to a different point in time. They say that they may question whether it's the best time to put new money into the market. After all, investing at all-time highs means you're paying a price that no one has ever paid before, creating a seemingly guaranteed recipe for regret. I mean, honestly, who's buying the S&P 500 today? They're paying an all-time high price for it, more than any other investor has ever paid for the market. But ultimately, this type of behavior of anchoring bias, or the psychological barriers to entry, is another form of market timing. Investors that do this are trying to time the market. They're trying to avoid buying at market highs and only buying at market lows. Timing the market is almost impossible to get right. And the market trading near or at its all-time highs is not uncommon. So you would be missing out on a lot of opportunities if you try to avoid them. This is actually one of the most counterintuitive topics I can think of, where buying the market at all-time highs is one of the best things you can do financially. For example, since 1950, the broad US stock market, so we're referring to the S&P 500, has set an all-time high record 1,250 times. Breaking this down by decade, in the 1950s, there were over 137 all-time highs. The 1960s, 218, the 1970s, 35, the 1980s, 189, the 1990s, 310. The lowest amount was in the 2000s. 2000 to 2010 was a really low point, but there was still 13 times where the market reached an all-time high. In the 2020s, there's already 104 times the market has reached an all-time high. This is something, again, that's so counterintuitive. When I look at my portfolio and the massive gains it's made over just a short period of time, it seems crazy to want to put new money into the market this year. It just seems like you're doing something irresponsible. You're buying stocks after they've already made gains, and that's something that's not fun to do. It's much more fun to buy companies when they've traded down to deep value territory. I love buying stocks when they're at low valuations. Remember when Microsoft was $220 per share? And I was pounding the table saying that this company's undervalued. Microsoft could be worth up to $400. Now the stock's almost $450. It's nowhere close to $220 where it was just a couple years ago. But good investors rely on good data. They rely on good decision making that's been proven over time. And the data says that the market reaching an all-time high and stock prices going up is not a reason to stop buying. In fact, if we break this down in different hypotheticals, we can see how much of an impact this actually has. For example, if you only were to buy at all-time highs, your returns are very, very similar to buying at any other date. If you look at this study right here, it examines the difference in returns over different time periods. If you only buy at all-time highs, your average return over a 1-year total is 11%. So saying that you bought the top of the market, you're the worst market timer ever, you're only buying at all-time highs, you earned an 11.2% return on average. If you bought at any other date, averaged out, your return was 12.6%. You had a marginally better return buying at another date than all-time highs. And in my opinion, the difference is not enough to make up for not buying. Sitting on the sidelines is incredibly expensive. If we bring this out to a 3-year period, your average return buying at an all-time high over 3 years is 10.9%. If you buy at other time periods where the market's lower, it does increase your expected return, but by less than 1%. It only goes to 11.5 from 10.9. This is a very marginal difference. If we look at this over a 5-year period, the difference becomes even smaller, from a 10.3% average return buying at all-time highs to an 11.3% buying any other time. That's a 1% difference. Marginal difference buying at other times. This data is again counterintuitive. It goes against all preconceived notions. Investors believe that by buying at all-time highs, they're being irresponsible and they're setting themselves up to lose a lot of money. But the data simply does not support these type of assertions that we make. If we look at another study, this time from Fidelity, we have a comparison over time of the growth of a hypothetical $5,000 investment. This is an all-stock portfolio under different conditions versus investing in cash. And this is from 1980 to 2023. So this is very applicable data to investing in all-time highs. If we had the best timing possible, your return would be $5.6 million. Which is incredible to turn that much money into $5.6 million. Now, if you just invested the money right at the start of the year and had no timing skills whatsoever, you still made $5.1 million. So notice the difference between the best market timer in the world, if someone existed that could possibly do that, which they can't, the difference between them and someone that does nothing that takes skill. All they do is they invest at the beginning of every year is only $500,000 out of $5.1 million. That's again a marginal difference between the best timer in the world and someone that's not timing anything. Then if someone invests monthly, they have a little bit lower return because they're taking longer to put their money in. That's $4.8 million. If someone has the worst timing ever and are only buying during the worst times, they still turn that money into $4.2 million. What this really illustrates out of these 5 different scenarios here is that there's 4 winners and 1 loser. The 1 loser is the one that sits in cash because they're too concerned at buying at all-time highs. The people that are convinced that they're going to earn a higher return, putting a bunch of money in their 5% interest rate cash account, are the real losers. They're the ones sacrificing millions of dollars over a 40-year period because they're too concerned about buying at different time points. The worst investor, the one that had the worst timing possible, still has over an order of magnitude more money than the smart investor that cautiously put his money in cash. So again, we can have these debates of what the market's gonna do and if we're gonna run into a recession. If the elections go a certain way and the market crashes, we can debate that in and out every single day. And these are fun little debates to have on CNBC and on different social media channels. But even with those debates, my advice is always the same. It's the same thing I'm doing with my portfolio. Keep buying stocks every single week, every single month, every single day if you can. Buy when the market's high, buy when the market's low, buy stocks all the time. Timing the market is impossible. Nobody can do it with any degree of consistency or accuracy. The biggest market timing losers investing at the worst times possible still end up with far more money than people sitting in cash. I'm following my advice as well. Even though my portfolio has reached near its all-time highs and things are going really well with the gains in my companies, I continue to add money to this portfolio periodically and add to companies that I think are the best value possible. It is true that it's getting tougher to find great value in terms of market multiples and valuations, but I do the best I can. I try to buy the companies that I think are the most reasonable valuations possible. When the market's at an all-time high, that doesn't mean that every single company's at an all-time high. Some companies currently present better valuations and opportunities than others. For example, on Qualtrim.com, which is a website that I developed, this is something that's available to all Patreon members. There's a feature called the Dip Finder. This is something that I've been using for years. It's very helpful in visually seeing how my stocks are trading. This right hand that's in the green are all my stocks that are trading with momentum, moving upwards. The more they're in the green, the more momentum they have. Right now, my food companies are the ones that are like rockets, going up 40% year to date. Texas Roadhouse is on fire. They're just killing it. Well, I think everybody knows about Chipotle. This stock is just like a rocket. It's doing so well this year. So I'm not buying these companies. I haven't put a buy-in for Texas Roadhouse or Chipotle this year. I'm just letting them run. I'm not selling any of them, but I'm still letting these stocks run. Another company's Costco that's just crushing it. It's too expensive for me to buy at this point, but I'm gonna let this one run. I don't like trimming my stocks that have strong fundamentals moving in the right direction. Then we have Apple with an amazing recovery with their AI demonstrations. We have Microsoft up to 450 now. We have Moody's making a nice comeback. But then we start getting into a territory where these stocks really aren't trading with a lot of momentum. S&P Global has been a little bit meh. It's in the green, it's been a decent holding, but it's only up 4.62% above its 200-day moving average. The 200-day moving average is a technical indicator for the momentum of a company. And so it's showing that this one is in the positive. It has a little bit of positive momentum, but not much. And then MasterCard is basically flattish, barely positive, and the same thing with Intuit. Intuit hasn't moved much at all. So I find these ones a bit more interesting. They catch my attention. They're ones that I look at as potential buys. I could potentially add to these ones at decent valuations. But then we get over to the ones that are actually moving down. Not only are these stocks not moving with positive momentum, but they're selling off this year. Canadian Pacific has not done well. The company's doing well, but the stock price hasn't cooperated. Then, of course, we have Vici. With interest rates going up, it's put downward pressure on companies that have long-term duration instruments, like the contracts they have with their tenants. This is the opportunity cost of investing in real estate. But then the worst stock of all, my worst loser by far this year, is Salesforce. Not only does it not have positive momentum, this one is minus 10% under its 200-day simple moving average. This is a stock that has negative sentiment, negative momentum. My favorite situation is when a stock is moving in the wrong direction, when people are becoming bearish on it, when they're saying that the stock is over, that software is over, that the new trend, the new thing to invest in is hardware. There's semiconductors, NVIDIA, AMD, TSMC, ASML, all the different hardware companies. And software companies like Intuit and Salesforce are no longer the thing to buy. And so I'm buying it. If I go to my Salesforce position, I bought another $2,400 of this stock, and I've made a series of purchases since it had its huge sell-off after earnings. I don't know when this stock will recover. It could trade around with negative sentiment for a year or two, but that's something I'm willing to be patient with. I think given enough time, if they continue to go along their path of growing free cash flow per share, keeping their stock-based comp under 8% of their revenue, and only doing accretive transactions, I believe this stock will continue to go back up to all-time highs. So when I'm allocating new money during a bull market, I'm doing it within the segment of my portfolio that's not a bull market. Right now, the bull market portion of my portfolio is this portion. Most of the stocks I own are in the green, but in every index and in most portfolios, there's a couple stocks that aren't keeping up. If those stocks still have positive fundamentals, I think it's a time to buy. And in my case, the stock I've selected is Salesforce. So you can do whatever you want with your portfolio, but as far as I'm concerned, I'm continuing to buy. Now let's go ahead and move on to some news here. We have news that the Surgeon General is now calling for a Surgeon General's warning, expressing how bad social media companies are for children.
Surgeon General Vivek Murthy, he wants to put a health warning label on social media saying it could be harmful to mental health, especially for young people. Now, it's going to be similar to the Surgeon General warnings that have appeared on tobacco and alcohol products for decades. And Murthy laying out his case for the label, which would require Congress's approval, by the way, before it can happen, in a New York Times op-ed this morning. And in that piece, he calls mental health a crisis for young people and points to research showing young folks who spend over 3 hours a day on social media have increased risk of depression and anxiety. He also points to the success of the warnings on tobacco products, which led to a decline in usage. Now, so far, Congress has passed 0 laws regulating big technology companies. That includes areas where there's pretty much universal and bipartisan agreement. That's, of course, protecting children online from things like bullying or sexual predators. Now, in the fall of 2021, a former Facebook employee, Frances Haugen, blew the whistle on the company, releasing internal Facebook research from 2019 that showed social media could make young girls feel suicidal. This is especially true on Instagram and among many other ill effects for mental health. Now, part of Murthy's call today, social media companies should share research just like that publicly. Don't keep it hidden. And in the meantime, Meta has made some changes to child safety in recent months, but only after a high-profile case in New Mexico's attorney general brought against the company. And overall, Meta has argued the burden should mostly fall on the app stores run by Google and Apple to better police children's access to social media apps. At the end of the day, though, no one with authority has done anything of significance, at least here in the United States, to help solve this problem.
So there you have it. You have the Surgeon General of the United States calling for a Surgeon General's warning on social media companies. Presumably, it would be when you sign up an account, it would have this big warning, similar to if you go and purchase tobacco. You know, there's a Surgeon General's warning on tobacco. Now, my immediate thought when hearing this and seeing it passed around the New York Times, Wall Street Journal, and CNBC was that this is not going to change anything. I don't think it's going to help anyone, because he's doing something here where the Surgeon General is trying to point out the obvious as though it's some type of novel revelation. He says, quote, "The mental health crisis among young people is an emergency, and social media has emerged as an important contributor." This is something that nearly every single person on planet Earth that has access to the internet is aware of. There's an overwhelming consensus that social media is not healthy for children. You could take polls on this. You can ask random people. The majority of people will say that social media is not great for children, especially in large amounts, especially when they consume it over 3 hours a day. Doing any type of submerged activity on a phone for 3 hours or more per day is not healthy. The difference between this and the case of tobacco is tobacco had a Surgeon General warning in 1965 when it was still heavily debated of whether or not tobacco was healthy. There was a huge movement saying that tobacco was healthy from the 1940s to the 1950s. We got into the 1960s and it was around 50-50. Many people still believe that tobacco really wasn't that bad for you. It really wasn't a problem. So in 1965, when the Surgeon General put an official warning on tobacco, that was a highly debated topic. But there's no ongoing debate with social media. If we have another warning on social media companies to match the other 5,000 warnings we've had about them, this is just going to be another thing that you have to agree to, that you have to look at before signing up an account, which everyone ignores and does anyways. Now moving on, we get to the news that Adobe is now being sued by the US government for their deceiving subscription practices. They say that the US government is suing Adobe for allegedly hiding expensive fees and making it difficult to cancel a subscription. In the complaint filed on Monday, the Justice Department claims that Adobe has harmed consumers by enrolling them in default, the most lucrative subscription plan, without clearly disclosing important plan terms. So they're kind of signing people up for the most expensive stuff without clearly laying out what it entails. And then the lawsuit also alleges that Adobe hides the terms of its annual paid monthly plan in the fine print and behind optional text boxes and hyperlinks. In doing so, the company fails to properly disclose the early termination fee incurred upon cancellation, quote, that can amount to hundreds of dollars, the complaint says. Adobe has a monthly subscription plan, and you may believe when you sign up for that monthly subscription plan that you are going to be charged per month, and then when you cancel, you simply pay for the month you're charged and you no longer pay anything. But what Adobe's really doing is they're signing you up for an annual plan that's paid monthly. So you've really agreed legally to an annual plan, but you're just kind of financing it every single month. And that way, if you cancel your plan, you're still on the hook for the rest of the year. Even though you thought it was monthly all along because you're paying for it monthly, nope, you're on an annual plan, and if you cancel, you have to pay hundreds of dollars. That is deceiving, and there's people that have been calling Adobe out on this on Twitter, saying that it's deceiving. One user says, just WTF Adobe, are you saying that if I don't need the software for 2 months, I can't cancel the plan? He has a screenshot saying that if he cancels his Adobe account, you'll be charged an early cancellation fee of $140. As part of the original subscription agreement, this fee will apply if you cancel now and end your annual commitment early. So you're committing to annual plans paid for monthly. And that's where all the confusion's coming in. Now, on top of this deceitful practice of sneakily signing people up for annual subscriptions and then saying that you're going to be charged monthly, the DOJ also alleges that Adobe's making it difficult to cancel their subscription. They say that when a customer attempts to cancel, they have to go through an onerous and complicated cancellation process that involves navigating through multiple web pages, pop-ups, and then allegedly ambushes the customer with an early termination fee, which may discourage them from canceling. So you have multiple pages you have to go through, you have pop-up, and then you're met with a cancellation fee. Customers encounter similar obstacles when attempting to cancel their subscriptions over the phone or via live chat. Subscribers often have their calls or chats disconnected or dropped when they're trying to cancel. They have to re-explain everything over again, the reasons for calling, when they reconnect. The lawsuit alleges that these practices break federal laws designed to protect consumers. This type of behavior of signing people up for one thing and then tricking them into believing they're on a monthly tear when they're really on an annual contract, and making it difficult to cancel a subscription should not be allowed. The companies that I invest in make it incredibly easy to cancel their subscriptions. Costco's subscription has a satisfaction guaranteed. If someone signs up for a membership and then a few months later finds out that they don't like it and they're not using it, Costco will even refund you the membership. Not only will they not charge you fees and make it difficult to cancel, but they will refund you your original membership. That is the practice of a good business. Netflix makes it incredibly easy to both sign up for their service and to cancel. You can go to your Netflix account anytime, hit 2 buttons, and your subscription's canceled. They do this because they don't want you to have the feeling that you're locked into them, that if you ever sign up for Netflix that you can't get out. They know that by trying to trap customers into their service like cable companies, that people become concerned about signing up. They become very hesitant to sign up. Netflix makes it as easy to leave as possible because they don't want people to feel trapped. They want people to feel like they can come and go as easy as they want. For my own subscription, for the exclusive videos, for Qualtrim.com, for my entire Patreon, I have the same practices. It is a free trial that's up to a month long. You join with no risk, and it's month by month. Cancel anytime with ease. People that sign up for the Patreon know that they're not trapped into something. They're not being cornered into a membership. People can come and go easily, and if someone is charged and they aren't fully satisfied, they can also get a refund. This type of practice is consumer friendly. Making something easy to cancel is consumer friendly, and ultimately it leads to better success. If they're tricking customers and deceiving customers, if they have thousands of unhappy people, that's obviously a need for change. And if Adobe's not going to make that change, the DOJ can pressure them. Now that's going to be it for this episode. I hope you enjoyed. If you want exclusive episodes, additional content, Ask Me Anythings, and full access to Qualtrim.com, you can check out the Patreon. Like we've shown, there's no risk to it. Other than that, I'll see you in the next one.